All right, everybody. Welcome to the session here. My name's Rodrigo. We're going to be with Mark Putrino, former hedge fund manager, traded with Mario Gabelli, Steve Cohen, a lot of experience in Wall Street, and chief educator at the Benzinga Trading School, otherwise known as Mark Putrino's Trading School. Let's go ahead and bring on the man of the hour here, Mark Putrino in the house. I believe we have him on the back. Let's go ahead and give him a moment here to get set up. 1 second. I believe he's all good there. All right, let's go ahead, bring on Mark. Big shout out. Let's go.
Damn, son, where'd you find this?
Yo, what's up, Mark? Can you hear me?
Hey, what's going on?
Hey, not much, man. The class was great today. I had a few minutes to pop in there in the morning. So many things being discussed there, but talk to me about your day at the trading school. How was that?
Well, a lot of the things that we're thinking we're gonna pan out have happened. We different things drive the market at different times, right? And that's where we get our trading ideas from. And we're really kind of focused on two things. And one was that the healthcare sector was really overbought. When I say overbought, it means that it's trading above what would be its typical trading range. And it also got close to a resistance level. So things that get overbought and get close to resistance, and resistance is a large group of sellers or people trying to sell at the same price. Things that get overbought and get to resistance, they tend to reverse. Now, healthcare is the second biggest sector in the market. Even though everyone focuses on tech, there are 10 other sectors. And the other thing we were watching was the important 150 level for Apple. Apple has been an important level, so I can just kind of show you on this here.
Yeah, go ahead and share your screen there, Mark. Let's whip it up with the technicals on the charts here.
All right, let me share my screen. Just give me 1 second. Hold on 1 second. I'm having a little issue here.
No worries, man. No worries. Yeah, everybody's looking at the mega caps. Market went, took a nosedive yesterday. Looks like it's going to do that again here today.
Yeah, I mean, the market looks pretty weak. There's no doubt about it. I mean, I think that we're going to be going lower. Let me just want to make sure everything's set up here right. Okay. Yeah, well, all right. So as I was saying, the market is made up of 11 sectors, and certain sectors are in control at different times. Sometimes technology is leading the market, sometimes healthcare is leading the market, and the market talks to us. One of the things we learned about at the trading school is that we let the market tell us what to do. We don't guess. We let the market tell us what to do. In a perfect world, you come in agnostically every day and you don't have an opinion if you're a short-term trader, and you let the market tell us what to do. So when we saw this healthcare sector, this is an ETF which tracks the healthcare sector. I mean, sorry. Oh yeah, I mean, I do mean healthcare. Double sorry. It's been a long day. When we have a big sector, right, overbought and gets close to resistance, and let me just clean this up here. One of the ways we can tell it's overbought is to use, one of the things we like to use in the class are these things called Bollinger Bands. All right. So you can get trade ideas, in the institutional trading world where I come from, things aren't as complicated in a lot of ways as people seem. Now, just to give you a little bit of my background to show you that, I've been around the block a few times. I'm not saying I'm the greatest trader in the history of the world, but, in 20 years, I picked up some stuff. I worked was hired into the business by Mario Gabelli. I spent time trading there. I was also worked for Steve Cohen, who is pretty much the owner of the Mets now. I don't know how actively he still trades. And then I was a head trader at 3 different institutional money managers. And these institutional money managers have various products and things that they offer their clients. And some were hedge funds, some were mutual funds, different hedge fund strategies. So when it comes to trading, I've pretty much seen it all. And one of the main ways we come up with trading ideas, and a lot of the students in the class actually made money off of this, even though it's on the downside. For people that aren't aware, there are ETFs that go up when the market goes down. So you could just buy a regular ETF, just like you'd buy a regular stock. And then if the market goes down, this ETF will go up. So you can amaze your friends, right? They're losing money and you're making money. But resistance is this line here, which for some reason, there was a lot of sellers around 133.50. When markets are going up, it's because there's not enough supply to fulfill all the demand. So the buyers have to pay higher prices. That drives the market up. When we get up to resistance, there's enough supply there or sellers that they can fill all the demand. So that's why the market stops going up when it gets to resistance. Then the sellers and the buyers start looking around and saying, wait a second, the buyers are leaving the crowd. Sellers might get more aggressive. So if you look here, when you get to a pretty simple dynamic, overbought markets that get to resistance tend to sell off, and oversold markets that get to support tend to bounce. And you can see that right here. So that's with support here. So this was a trade that some of the students made. These red lines are called Bollinger Bands, and they are 2 standard deviations above and below the 20-day moving average. Now, this is important because a lot of the algorithmic trading that's done today, it's driven by statistics, and Bollinger Bands and standard deviations are a statistical concept, right? So if something exceeds one of these thresholds, that gets the attention of these algorithms, and it pulls them into the market. And if something's oversold, it pulls them in as buyers, and because they're expecting a reversion to the mean. So one of the main things that we stress in the trading class is that you don't guess. You let the market tell you what to do. And the way the market talks to you is by telling you how it reacts when it gets to certain levels of importance. So I'll give you an example now of how some of the students have made some money over the last few days, right? So this 390 level on the S&P 500 it's an important price level. It was support back here in May. Then it turned into resistance, and then it turned back into support, and then it turned into support again. Then it turned into resistance. And then once it didn't get through, I forget about the Fed talk and all the stuff you hear on the news. The way the market talks to you is by telling you what it's going to do by how it reacts when it gets to a certain level. So when this got to 390 and it became apparent it wasn't going to break through, it started to sell off, and it was very weak. It actually broke right through this level. So I suspect we get some more downside. Now, for those of you who don't buy puts or not options traders or short stocks, there is a way to make money in the market when it's going down by buying ETFs that go up. For example, if you bought, well, take a look at this chart and then take a look at this chart. The symbol here is SH, Pro Share Short 500. It's the exact inverse. So if you think the market's going to go lower and you're not a sophisticated investor and you don't want to buy puts, or although most of the students in the class are options traders, we do basic option strategies. So if you want to learn about options, basic options, it's a good place to be. But the key is that I'm trying to get to is that there are ways to make money when the market's going lower. And here it could be as simple as buying an inverse ETF. Now, there's also ETFs that are leveraged. Look at this one. SPXS. So this is designed to go 3 times the amount that in the opposite direction that the market moves. So if the market moves down 1%, this should go up about 3%. So look at how much this has moved. This has moved from 22 up to 25. So whatever percentage that is, that's big money for a few days there. So, part of the learning trading is obviously learning the different systems, the moving averages, the charts. But one of the things we teach in the schools is how to find different ways to get exposure to different parts of the market. A lot of the students have done really well by trading natural gas ETFs. So they don't trade actual natural gas futures. This is natural gas here, right? This is a future. They're not futures traders. What they do is they buy these ETFs. This ETF here called BOIL, or symbol is BOIL, this thing is designed to move twice as much as the natural gas does, right? So if natural gas goes up 1%, this ETF should go up 2%. If the natural gas goes up 3%, this should go up 6%. On the opposite side, if we think natural gas is going to go down, we have this ETF that we use. This thing is designed to go in the opposite direction. And as a matter of fact, this is probably something from a trade that we did where this thing was up 35% in just 3 days. So it's not just learning about the trading styles, it's learning about what instruments you can use. When the market started falling apart in November, we saw it, and in January we saw it, and I could show you why we saw it and what we were looking at. But a lot of these money managers on TV are like, "Oh, go to cash, go to cash, go to cash." It's like they don't even know that these inverse ETFs are available. So I want to explain to you guys something and why we started to see the market, why we got bearish, like right in here, right before we had the sell-off where the whole inflation thing hit. This benchmark is the S&P 500, right? This is a price weighted average benchmark, meaning the bigger the stock is, the more influence it has on the benchmark. There's 500 stocks in it. That's why it's called the S&P 500. So what was going on here was people were selling a lot of their less favorite stocks or the stocks they don't like, and they were fleeing to safety. They were putting money into Microsoft and Apple and Tesla and the companies that are big. So in theory, you got 500 stocks here. If you could have, 400 of them going down, 80 of them being neutral, and 20 of them going up, and the broader market is going to look like it's going higher. So this masks the underlying weakness. One of the things we look at is this particular ETF here, which is the NASDAQ 100. But in this, all the shares are equally valued. In other words, Apple has the same value as the smallest stock in the ETF, like the same weighting. And look where it broke its uptrend here in November. So this was an early sign that we were coming to a peak. So a lot of the students, they got in, we saw the market was going down, and they took advantage of these inverse ETFs or regular ETFs. And I think you printed some nice coin back. Was it here, Rodrigo, where we had this big sell-off here?
Yeah,
a bunch of the students said that this couple of these trading days in here were the best days they ever had in their careers because they bought calls on the inverse ETF, the one that's designed to go up 3 times. And it was real simple. We just saw an important support level broke, and that was the key to get in. So by letting the market tell us what to do, we're not guessing. A lot of people just guess. Now I can explain to you why you might see something like this, right? When you look at a chart, we're looking at investor psychology. We're not looking at tea leaves or astrology. There's a reason why a level that was support could become resistance. And this is why it's so important to understand that certain levels are more important than others. I think that just knowing where these important levels are is going to make your job, 95% easier. Well, maybe not 95%, but way easier. Knowing where the levels are and knowing how to read charts, it's like it's like having a map, right? Like if you went into a town that you had never been in before and you didn't have a GPS or you didn't have a map, you wouldn't really know where to go. And it's the same thing with the market. If you don't know where the levels are, then you don't know what to do. So there's a reason why this level that was support became resistance. And believe it or not, it's because of buyer's remorse. A lot of people who bought shares here thought they were the king of the world, or Mario Gabelli or Steve Cohen when the shares went up. But then when all of a sudden it goes below and they're still holding it, a lot of these people say, man, I shouldn't have bought that. I made a mistake. I'm going to try to get out, but I'm only going to try to get out if I can get out at break even. So they place their sell orders at the same level that they bought at. And if there's enough of these sell orders, it converts the level into resistance. So support converts to resistance. And we can see here, resistance converts back to support. This is the opposite. This is seller's remorse. People sell and they regret selling when the market moves higher. And then they say they want to buy their stock back, but they don't want to pay more than they sold it for. And they say, if it gets back to my level, I'm going to buy it. So they place their buy orders at the same level they sold at. So support can become resistance. Resistance can come support, and support became resistance. And when the SPY did not get through this resistance, it told us that there was a good chance the market was going to reverse. This is the market talking to us. The market is saying, hey, I can't make it through 390. It's time to sell me. Sell, sell, sell. So I think that's one of the reasons, Rodrigo, why the students find the class, I guess, kind of refreshing in a way, because they think that these institutional money managers, these legendary guys like Paul Tudor Jones and, Gabelli, Cohen, that they have these secret systems or these secret models that they use, or that they're always right. And that's just not the case. That's not how it works in the real world. The best traders understand the basic principles, and that's what we teach in the class. We teach how to identify what's an important level, support, and resistance. And this knowledge can be utilized, right? Like if you bought here and it's going higher and you say to yourself, where should I sell? You look here and you say, oh, 390 was an important level. Well, maybe that's where I'll place my sell order, right? And I don't know why. Why is it 390, not 386 or 392? I don't know, but we don't really need to know. So this is part of the whole concept of letting the market tell us what to do. So I know some of the students have done pretty well on getting on the short side of this. We have a lot of option traders, and a lot of them were buying puts on biotech. So a lot of them did very well yesterday once it became apparent that this resistance wasn't going to break. If something gets to resistance, just picture in the old days, like the people down on the floor of the stock exchange, right? They'd all have to go in front of the same, what we would call a specialist, to trade the stock. So if you're in the crowd and everything's going back and forth and there's buyers and sellers at 133.50 and it's trading smoothly, you're selling, you're buying, blah, 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 blah. Now you got a big sell order, and all of a sudden you notice a couple of the buyers have left the market. And then you see some more sellers are coming into the market. Well, you start to say, hey, I better lower my price, because if I don't have the lowest price in town, these guys are going to go to somewhere else, and I'm not going to be able to get my client's order executed. So one guy might say, gee, I'm going to go to, Mark went to 133. I'm going to go to 134.50. Next person says, I'm going to go to 134. And that starts this cascading effect. So this is why when things get to an important level and they don't break through, they tend to reverse. So we can make low risk trades and build trading systems of something as simple as buying when something is oversold and at support, and selling when something is overbought and at resistance. So a lot of people ask me, the students really seem to like the class, and they're like, they ask me, well, why do I think that is? And they tell me it's because I explain things in a simple manner that people can understand.
Right.
And, you know, it's Wall Street seems like a very mysterious place to a lot of people. There's a lot of conspiracy theory about, you know, what market makers do and what hedge funds do. And, you know, I mean, I'm a guy who was a market maker for 2 years, right? And I've probably overseen the trading of about 20 different hedge funds. So, you know, so my experience translates into things that people want to learn. I have a lot of knowledge of things that people want to learn about. You know, Rodrigo, it's kind of, trading's kind of funny, right?
Mm-hmm.
Right. I think you'd probably agree. It's like, if you want to be a mechanic, you got to realize you got to go to, you know, mechanic school. If you want to be a lawyer, you got to go to law school. For some reason, people think that they can just go online and become a day trader without knowing anything and make a lot of money. And that shows you why 95% of new traders fail. And because they just come in and they guess, they get ideas out of a chat room. If you don't have a logical reason for getting into a trade, I mean, this was a logical reason. I mean, of course, it could have kept going higher and broke the level, but we waited for it to reverse and tell us that it was going to go lower. And then that's when people jump on board. You're not going to get the absolute highest price, but you get the right trend.
Right. Right. So let's say, for example, when you're looking at something like, you know, the triple Qs, right? And this is personally for me, but I know many other traders out there do the same. They use your levels, and from their levels, they pick the trade. Some people will trade options, other people will trade stocks. But when it comes to the levels, that's really the signal. That's what you're trying to say. That is the market telling you what to do, right? The message, correct?
Yeah, and I mean, this one here is a little more volatile, obviously, because it's technology. And, you know, we have to speak in really, I talk about levels, but it's really more of a kind of a range. I mean, this is a $280 stock. So for it to have a range or a zone, let me put another line in here, of a couple dollars is not, you know, not unusual. We're not going to get it to the exact dollar, but we had support over here. And when we get over here, we rally. And we have resistance, Remember, we have these remorseful buyers trying to sell. If there's enough of these remorseful buyers trying to get out, they place their sell orders, and what was support turns into resistance. And when things don't break, they go down. Now, this is pretty interesting because notice how Qs has reached this prior bottom. This day was, I forgot what happened on this day. It was kind of an anomaly, but it traded up through the levels. You know, I like, if someone is short Qs right now, I think our target in class was, what was that? My internet connection is unstable. When someone, the target in class we talked about was 260. And it got there today. So I would imagine some of the students have closed out of their positions. And what a lot of them like to do is trade these leveraged ETFs. And I know you do too. Like, we have SQQQ, which trades 3 times the reverse or inverse to the Qs, right? So look at this. So Qs have been going down, and in the last 3 days, this has gone from 49 or just say 50 all the way up to 61. So that's a 20% return in 3 days, just from understanding that the Qs failed that resistance.
Mark, do you only use daily on your charts? Do you ever look at 10-minute, 5-minute, 1 minute, or is that not really that important for you?
Oh, no, we definitely do, because we have a lot of day traders. So that's a good question, Rodrigo. Let me just bring up, I don't know, let's take a look at say Tesla, for the heck of it. And it's in people that are short-term traders or day traders, they'll ask me, you know, how far back should I look on a chart if I'm just a day trader? And the answer is you should look back, because a lot of times when you have a big move, if there's no news, it's just because of the way something is reacting off of a price level. So if you came in here today to trade Tesla and you just say all you saw was this today's action, you wouldn't be aware that there was the last time it got down to, or this opening around 210 is an important level. You see, we traded there, right? So now if you're a day trader and you look at your 1-day chart, which is this, you would have said, hey, this got down to a support level. You know, I'm gonna buy it around 210. But you wouldn't have known that there was going to be support at 210 unless you had a longer term picture on it. So I think one of the most effective ways to trade short term is by being aware of what the longer term dynamics are. If you're just looking at myopically at a really short term chart, you might miss some of the longer term things. Now, sometimes things are at a position where longer term fundamentals are not in play and you don't have to worry about it, but sometimes they are in play. I think, as a matter of fact, I think that's one of the most effective ways to trade, is to trade short term off of longer term fundamentals. Something gets really oversold and gets really, are overbought and gets resistance or support. Then we look, that's what we look at. So let's take a look at UNG. This is a natural gas. It's an ETF. It trades just like a stock. So don't say to yourself, Mark, I'm not a commodities trader. Why is this important to me? Well, because the same rules are, first of all, you can trade the ETFs. So you can get exposure to commodities, and the same principles apply, whether you're looking at longer term or shorter term. You have short-term support levels, you have longer term support levels. So this thing has been kind of range bound. So I would say your longer term level is 18 on the downside, and your longer term level on the upside is about $20.35. So it's good to know where those are. Now what I'm going to do is I'm going to look at the 5-day chart, and we can see that that's the longer term resistance up there. And this is the shorter term resistance down here, right? So this is 5 days. So now we can kind of tighten this up a little bit here. We can see, oh, look at this. This resistance from, what's today? Thursday, this resistance from Tuesday has turned into support today. So one of the interesting things about trading is the fractal nature of it. The same principles apply. Like if you didn't know if this was a 1-year chart or a 1-day chart or a 5-day chart, you wouldn't know, but the same principles still apply. You see, a level that was resistance remained resistance, a level that was support became support again, and then here we have the shift from resistance to support. So now let's bring that down even one step more to the 1-day chart. And if you're a day trader, you know that this level around 1932 here is support, because it was support back here 2 days ago. So it's like those, it's like those Russian dolls, right? You got to look at the broader picture, and then you look and you work your way down and you work your way down and you work your way down. But yeah, we look at well, like I said, most of our traders are day traders, but whatever your style is, you're going to benefit by understanding how to identify what are the important levels, what are the trends, what's the momentum, and most importantly is the risk psychology. People think, or investment psychology, people think that the great traders are great because they have these secret systems that they work. But the reality is the difference between a great trader and a person who's not a great trader a lot of times is the emotions that they have, right? Why do we have panics? Why do we have crashes? Well, people panic And that's an emotional response. They're afraid. So they just end up finally panicking and they throw the baby out with the bathwater. Why do we have bubbles? Because people get euphoric. A lot of students try to figure out the market with logic. And I tell people, you can't, because the market, this is a reflection of people's opinions. I think this is actually a good stock. We talk about this sometimes. All right. So this is Tilray, okay, the cannabis company. This company loses hundreds of millions of dollars. And somehow it got up to $300 a share. Now, this was nothing more than investor euphoria. This was not logic. This was like a herd mentality. And that's why we talk about how psychology is so important. The question is not why is Tilray trading at 378? It's why did it trade at 300? And frankly, it's probably going to go lower because they still don't make any money. The same thing with Bed Bath & Beyond. There was this whole big discussion about this. There was going to be this gamma squeeze, which means that this guy, what's his face? I forget his name, Cohen. I think it was it Ryan Cohen? Supposedly he bought all of these. Well, it's not supposedly. I know he did. He bought all of these way out of the money calls, and what was going on in all the Reddit chat rooms and all that stuff was like, oh, there's going to be this big, what they call a gamma squeeze. They're going to have, these market makers are going to have to go out and buy these stocks and buy huge amount of these stocks to cover their short option positions. And that's just complete nonsense. I mean, that's not how that, I mean, it works like that sometimes, but there are other ways that they can hedge. I mean, they can hedge with other options. So a lot of the retail investors thought that this stock was literally going to go to $80. Look where it stalled out. Right at the same level that it hit resistance in March, and right at the same level that it hit resistance last year in July and August. So, all the noise, what you hear on CNBC, what you read in Reddit, forget about that stuff. It's just going to make you confused, and it's going to make you lose money. But if you want to make money, you got to understand these basic principles. Now, markets will change, right? The names change, the companies change, but human psychology doesn't change. And until it does, and it's probably not going to anytime soon, we're going to have panics and we're going to have bubbles. But ultimately, forgetting all the noise, if I knew nothing about the whole alleged gamma squeeze in Bed Bath & Beyond, I would have looked at this chart and say, I was on a desert island and I didn't have any news. I would have said, oh, this thing got up to resistance. Oh, it's reversing. I'm going to take a short position. Maybe I'm going to buy puts on it. And, it's not anything secretive. It just shows it was extremely overbought and it hit resistance. So one of the principles of markets is overbought markets that hit resistance tend to sell off. And that's exactly what happened here. So I know a bunch of the students were able to profit on this. So a lot of it, Rodrigo, is, people like when Rodrigo and I talk to people who join the class, like, why did you join the class? And the obvious answer is, well, because I've been losing money and I don't really know what I'm doing wrong. And because of that, they guess, right? Or they just ask someone to do. There's 3 stages of a trader's development, I think. One is the very first stage is you come into the market, it just seems really confusing. It seems really mysterious. You don't know what to do. And you ask for people's advice. So you go into some Reddit chat room or you listen to someone on CNBC. All right. So maybe you get 1 or 2 lucky trades, but after a few days or a few weeks or whatever, you realize that doesn't work. The next step is stage 2 is to start thinking that you could come up with some kind of secret super model that works all the time. And look, you can even see that this 450 level that was support goes all the way back to here. Like there's some secret system that works all the time. And then people realize that that doesn't work. Then they get to stage 3, and that's where people really start to learn. And that's the secret of the successful trader, is understanding how to read market psychology. Like I came across this chart this morning because Leon Cooperman's making some investment. He's an activist investor, and this is not a recommendation, but I just want to show you guys how this is like long-term psychology, right? So we can see here, back in May of 11, people sold, right? A lot of people, when it went down, probably told themselves, yeah, this is great. This is great. I sold, it went down. But then when it gets back above that, the psychology kicks in. It's the seller's remorse. People say to themselves, hey, I shouldn't have sold. I'm going to buy my stock back, but I'm only going to get it for the same price I sold it at. So they place their buy orders at the same level they sold at. And this is, 2 years later. So some of these levels can stay intact for years and, maybe even decades. I mean, look at, just to show you just how powerful this knowledge can be, I guess, for lack of a better term. Look at, this is Bristol Myers Squibb, right? Look at this. It's trading at 78, but the peak in here, right back here, was 74. So we're in a couple of dollars. This is 1999, right? I mean, this is 23 years ago. This is 8 years ago, and this is now. So some of these price levels can stay intact for a long time. So I don't think you can be a good trader, swing trader or day trader, if you don't understand how important it is to know where these price levels are. So we have 8 classes. The classes focus on fundamentals. The first class 1, and it's not that you just take 8 classes and we say see you later. We take 8 classes and we get to the end, and then we recycle and start from the beginning, because the markets change, but the principles of markets don't. For example, as long as there are financial markets, there's always going to be price levels that are more important than others. Stocks are always going to be trending. They're either going up, going down, or going sideways. So we have a class on levels, how to identify the important levels. And you could take the stocks that you trade and figure out which important levels are. You can see here another example, resistance becoming support. We have a class on how to understand trends and momentum when something's overbought or oversold. We have a class on basic options for people that are just getting started off.
Right.
We don't get into anything too complex like my colleagues Chris and Nick do, but basic option, it's a basic option class just to learn your basic strategies. We have a class on patterns, what the head and shoulders patterns means, what's a rectangle pattern, what's a ascending triangle, things like that. Then we have a class on market psychology. Then the 7th class is how to look at the broader market sectors, like we were discussing before. And then we have the class 8, which is which is on how to build trading models. So a lot of people think by just having a lot of fancy indicators on their charts, they're going to figure out how to be successful, but it's not the actual indicator that's going to help you. It's the rules that you use to interpret it.
Right, Mark. And let's take a quick look there at Google so that you can let us know what you think there. And a quick question, how do you look at volume? A lot of people look at, when volume kind of dries up, people think it's bearish. Is it bearish? Is it bullish? Is that something that institutions look at when it comes to volume on a stock trading for that day?
Well, I mean, an institution's going to look at volume for the most basic part for just liquidity. I mean, if you're trading, if you're trading $1 billion fund and you want to put 2% of your money into something, that's $20 million. So you got to make sure that there's enough volume for there to be liquidity. In general, retail traders don't look at that. What I look at volume, the two things I really consider is sometimes when we get to the end of a trend, we see big spikes in volume. And that's why I don't think that we're at the so-called capitulation yet. Yeah, I mean, see, we had a big spike in volume there, but now we're still trending lower. But if at the end of a trend, a lot of times there can be a really big spike in volume. And I wish I could think of a good example off the top of my head to show you guys. Well, I'll think of some, but what happens is this, right? You could kind of see it like right here. I mean, it's not a great example, but just to explain this is a better example, but just to kind of explain the psychology here. So I pay attention to if something's really overbought or really oversold, if there's a big spike in volume, and we call that a capitulation, right? So this is kind of the mechanics behind it. You have, just pretend you're a guy like me, and you were you have a big order. When I was a trader, I would get well, look at that. I'm just looking at the price 38, and back here it was last August was 300. So the stock has been crushed too. But anyway, just pretend you got an order to sell 1 million shares of Wayfair, and it's trading at $300. All right. So you got your order to sell 1 million shares, and you sell 100,000 at $300, and you say, all right, so I sold 100, I leave 9. I'm going to try to sell another 100,000 at 300. And you can't. It starts to go lower. So you say, damn, I got to sell it at a lower price. So I'm going to sell my 200,000, another 100,000 shares at 295. So now I've sold 200,000 and I leave 800,000. I'm going to wait for the price to go higher. And then, you're like, all right, I'll sell another 100,000 here. It went my way. So now you got 300,000 sold and you leave 700,000, and it just keeps going and going and going and going. And finally you say to yourself, you know what? I'm sick of this stock. I want out. I'm just going to be an aggressive seller. Just get me out of it, right? Just you tell your broker, just sell it. I don't care about the price. Make it go away. That's a common expression on Wall Street. Make it go away. So what happens is all these sellers kind of throw in the towel, and the baby gets thrown out with the bathwater, so to speak. And when investors realize, well, wait a second, that news isn't as bad as it really appeared at first glance. Let's go in to buy. Well, guess what? The sellers have all kind of left the market. They all threw in the towel, and there are not a lot of sellers around. So the sellers have to pay, or the buyers have to be willing to pay premiums so they could drive in sellers off of the sidelines. So that's why after we get these big spikes down and we get these big volume spikes here, a lot of times we get a move higher. So we look at volumes for capitulations and liquidity, but I know why people suggest that, because if you read the books, it says like volume confirms a trend. Like if a trend is going higher, but then the volume starts to decline, well, that's a bad sign. I mean, I don't know. I mean, I've been doing this a long time, and I've seen a lot of stocks continue to trend higher, even though the volume dries up. So that's why it's not like a main focus, but if we see like right here after a big sell-off, right? This is 290 down to 250. Well, look at all the volume that traded there, right? So then when the buyer, whatever news drove this down, buyers come back in, and it's, they got to pay higher prices. You can see here, resistance level is pretty clear. So volume, most of the time we don't pay attention to volume, but we do pay attention to volume to see if something's liquid enough to trade. Like if it's a stock that only trades 1,000 shares a day, it's probably not something you want to touch because, or I'm not going to say you don't want to buy it, but you just got to be aware that if there's ever any bad news, it could really move a lot. If it only trades 1,000 shares a day and someone comes in and says, I got to sell 5,000 shares of the market, that could knock the stock down, by a significant amount. So I only recommend trades in stocks where there's sufficient liquidity. And I really only pay attention to volume to see if we're going to get some kind of capitulation. And I'll just show you the last capitulation and why I don't think we're close. And this is the S&P 500 spider again. Move to, all right. I don't like these colors, they got the green and the red. I don't think it really makes a difference up volume or down volume. And I can explain that if you want. But just look at the volume where we are now, right? Now let's go back to COVID crash. Like this here is a capitulation. This thing was trading, 75 million shares a day. Then there was a couple of days where it got up to 400 million. This is the people throwing the baby out with the bathwater, so to speak. They're like, I'm done. I'm sick of looking at this. I'm in a panic. They tell their broker, just get me out at any price. And as it turns out, that ends up being a good time to buy, because when when buyers start to return to the market because they think, oh, the news isn't as bad as it first seemed, there aren't any sellers around to sell to them. So they got to pay higher and higher prices. And then we can see even back here an example of what was resistance becomes support. So I think the market's going down to about 3. My price target, I mean, I know this is really precise, and I'm just there, we always have to say like around and about, because like I said, this is an art and not a science. Well, I think I said that. I might have said it this morning. But if it could be completely figured out by math, if it was a chess game, these AI funds would have great performance, and their performance is actually really lagging. And the reason why is because they use statistics and probability theory, and statistics and probability theory presume or assume that people are rational. So that's why those mathematical funds don't work out. The best human traders can still outtrade them. But I just want you to look here. There's kind of 3 things going on here. And this is, again, the S&P. So the S&P 500 is around 3,728. This is 100th of it. This is the ETF that we look at. And we look at this is because a lot of people trade this. People don't really trade the index, they trade the ETF. But since 1929, there have been 25 bear markets. And the average move lower in these 25 bear markets is about 35%. All right. So the top was around 480. If we go down about 35%, that puts us down to around 320. So that's one reason why I think we could get there, if it's just an average bear market. The second reason is that if the market got down to around 320, it would be in line with his historical valuations. In other words, the price to earnings ratio would be like the same average that it has been if you go back 100 or 150 years. So you could argue that at around 320, the market would be fairly valued. And the third is that, well, the 320 was an important level, and we've seen how important levels can stay intact for a long time. So the way we would be trading this now is, as long as we're below this 375 level, I think it would be safe to stay on the short side of the market or to buy some of those inverse ETFs I mentioned. If we get back above that, well, then we get stopped out and we take a small loss, and maybe the trend continues higher, and then we shift our positions and get onto the long side of the market. But I think it's going to take a few days to resolve. I do think we're going to go lower. If we break here, then the next stop is down here. See, markets don't go in straight lines. They're like a staircase. each it forms a trading range, and the way up, say we have a trading range. Well, the top of what was a range, the bottom of the next range, and then the top of the next range becomes the bottom of the next range. It's the staircase, and on the way down, it's the same thing. What was the bottom of the range becomes the top of the next range. So it's not unusual for a stock to come back and retest and then go lower. So my guess is we're going lower, but I would be on the short side. Next stop is probably 365. And then if this breaks, we're probably going to go down to 356. And the reason why I'm saying that is because of the price levels. This was kind of a clear bottom here for 3 days, right? And this was kind of a clear bottom with the exception of this kind of anomaly here for like 2 weeks. You don't really see any clear levels or clear peaks or valleys in between there. So for some reason, for just whatever the market thinks, like 361 isn't that important of a level, at least not yet, but 356 is. And that actually goes back to, believe it or not, 356 here. So, we kind of have a joke in the class because someone wrote my boss like an email saying like I should I should give like a trick every day. I should teach a trick. So now every time like something gets to where we thought it was going to go, I'm always like, oh, abracadabra. We don't teach tricks. We teach education. But anyway, why was there support at 356 here? All right, let's go back in time. 356 was resistance in September of 2020. So I know some of the students got this bottom within a point. And again, it's not magic. I don't have a secret system. I'm not some super genius or anything like that. I'm just someone who's been doing this a long time. And I realize that it doesn't need to be as complicated as you think. If you just focus on these principles, you can do all right. And then I guess that should bring up my next point is that a lot of times why people fail is because they try to adapt a style that's not consistent with their personality. You need to do something that fits your personality. That's why I don't believe in this like watch me trade classes. Like, you sign up for my class and watch me trade. Well, everyone has a little different style and you got to do what fits you. And people have different eyes. A lot of our best ideas, Rodrigo, have actually come from some of the students, stuff that I didn't see. Yeah. So you got to keep it simple. You got to pay attention to the levels and the trends and the momentum and the risk management and psychology. And part of psychology is doing something that fits your personality. Like, for example, I always tell people, if Tom Brady was a linebacker, he wouldn't be that good, right? But as a quarterback, he was obviously great. So that's another reason why people make mistakes. Right. They try to fit the round hole into this, or the square peg into the round hole.
Yeah, and really quick here, we're getting a lot of questions here from the folks about the school, so we'll just get this out of the way.
All right, I'm going to take a 30-second break and go just get myself some more water.
No worries. So, folks, thanks a lot for the questions. We'll get through this really quickly here in a minute before Mark comes back. Are the classes recorded? Yes, all the classes, Monday to Friday, they're recorded. Does everybody that joined get a free laptop? Yes, everybody will get a free laptop. The schedule is Monday to Thursday. It's 7 to 9 a.m. Eastern and 12 to 1 p.m. Eastern. And then Fridays, it's 7 to 9 a.m. Eastern. Let's see. Is this for one trading style only? No, this is for people that either trade options, stocks, crypto. It doesn't matter. Technicals and market structure. These are all things that everybody should know. These are the basics, but for some reason, the basics get overlooked many times. And let's see, is there a money back guarantee? Yes, there is a 30-day money back guarantee. The price at renewal is the same as today, 70% off. Let's see, next question. What kind of strategies does Mark teach in the school? So Mark will teach different types of strategies, everything from people that are day trading, swing trading, options trading, these are all things that every single trader can use. So the trading school is basically, imagine like when you are building a building, right? I know that's how you say it, but when you're doing that, you need to lay the foundation, right? If you don't have a good foundation, the building is going to be shaky, right? And it might not withstand an earthquake or hurricane, who knows? But really, the foundation is where we need to focus on, because with a good foundation, other things, other great things can come about. But with a weak foundation in anything that you do, uh, you're always going to have problems because you pretty much skipped a lot of steps. It's kind of like trying to skip elementary and middle school and just go straight to high school trigonometry. So you're obviously going to fail. And that's why a lot of new traders fail, because they typically skip steps. They just want to get in there, buy any call or any put or any stock without knowing what it is or how it works or what's really happening in the markets. There's a lot more to trading than just buying and selling. And really, that's what the trading school will show you, that there are different things to take into consideration. And as a trader, you have to put that into your schedule, right? You need to have a plan when you make a trade. You need to know, okay, this is what I'm trying to do. This is what, the levels that I'm looking at. This is probably where I'll get in, get out, and ultimately have a sense of awareness of what's happening in the markets. Like, why would somebody go and just go bullish today after, yesterday's price action? You also have to look at what's happening around you, right? With the Fed, with rates. These are all things that impact the markets a lot these days, especially. So yeah, but we pretty much teach what Mark does. He teaches all these different types of trading that all pretty much come about from the same foundation. So I've seen people that trade day trade options, swing trade options, do spreads, buy stock and that sort of stuff, and they go by the levels. Okay, there's no magic to it. You just need to know how to do it, right, Mark?
Yeah, just I mean, let's just look at some random stocks and just we'll see. I'll tell you what, I'm just going to close my eyes and I'm going to point to my keyboard and I see the letter V. So let me bring up Visa. And if if Rodrigo, if any of the people out there wanted me to take a look at something, you just let me know. But all right, so here's Visa. We've obviously looked at it before because it's got lines on it, but we can see the principle here of this resistance level, right? So the reason why it's important to know where these things are, I mean, it doesn't take a lot of imagination to know that if you can figure out where a market's going to turn, you can make a lot of money. So let me put one of our Bollinger Band momentum indicator on there. And I just like to clean this up a little bit here. So here is, like I said, just a random stock that we just picked by me closing my eyes and pointing to my keyboard. And look at this here, right? So this could have been, say you bought it while it was down here. And you think to yourself, well, actually, let's just say you bought it when it was down here. So you see it got really oversold, and for some reason you like Visa. And we could talk, one of the things we talked about today was trading models. It's not having all these different things on your screen, it's knowing how to apply them. So the Bollinger Bands, the trick is not to buy once it gets outside of the Bollinger Band. Usually you want to wait for the reversal and wait for it to get back in, because that'll tell you that the trend is probably reversed. If things can be overbought or oversold for a long time, like if you just bought the Bollinger Bands because we got below the Bollinger Band, you would have bought up here. If you waited for the reversal, you would have gotten in down here. But anyway, say you buy down here because it's really oversold. And you say to yourself, all right, I'm going to sell Visa if it gets up to 240. Well, guess what? You had the right idea. You knew the stock was going to go up, but it got up to 235 and then it rolled over. So you missed your target. And if you paid close attention, you would have noticed this right here. Okay. This is 235. This was the precise high trade. So, this is 4 months later, 5 months later, literally within $1. It stopped at the same level. So had you not looked back and seen that this was resistance, you could have had the right idea, but it doesn't get to your target. And then the thing all of a sudden comes all the way back, and you end up, if you held it, you would end up losing money. Now, if you were aware that there was resistance there, you could have said to yourself, well, gee, there's resistance at 235. So what I'm going to do is I'm going to place my sell order at, say, 233, a little bit below it. So it's not as good as selling it as 240, but it's better than missing it. So by knowing where these levels are, it tells you where to put your price targets. And it could also tell you where to buy. Visa goes into a big sell-off and you say to yourself, man, it's oversold. I'd really like to buy it. Where should I buy it? It's trending lower. What's the bottom going to be? Well, if you just guessed, we call that on Wall Street, we call that catching the falling knife. If you just guess, because that's the term for someone buys something and then it just keeps going lower and lower and lower. And, you end up getting run over. Now, if you wait for the market to talk to you and you listen to the market, you would have said, all right, well, there was support around 190. We got to 190 support, and now we're back in the range. So what I teach is that it's best to wait for the reversal to happen and not try to just guess. If you try to catch the bottom, you're really just guessing. So we're oversold. We're coming off of support, and this would have been where we bought right here, right? But again, support becomes resistance. If Visa gets down to 190, which is only, well, let's just say, let's say 190. If Visa gets down to 190, there's a good chance that there's support here and it bounces, especially after a big move like that. So let's just pick another, I don't know, what's the stock of the day today? What's in the news here? Bank of England raises rates. Lyft plans to lay off hundreds of staffers. So let's look at the chart of Lyft. Let's see. We could just see here. 1, 2. And now let's see if we could see some of our principles at work here. I'm sorry, Rodrigo, did I interrupt you?
No, I was just seeing there that looking at Apple, weakness may be due to bearish outlook on the smartphone market from Qualcomm. It was reported on Wednesday that the company has put a hiring freeze in place for next year. That's Qualcomm. So I guess that's why Apple's is doing pretty bad. I don't know.
Well, look, I'll take a look at that in a second. But I just wanted to show you here, and obviously this is a stock that we've looked at before. I mean, I forget when it was, but we can see support becomes resistance, right? That's that market psychology. Support becomes resistance. But let's take a look at Apple. One of the two things that told us that this move lower was coming was the fact that Apple, I told the students that if Apple, there's no way the market's going higher if Apple doesn't stay above 150. So once this came down below 150, we knew that the market's just not going to go higher when you have a really important stock trading under resistance. And then you have the second biggest sector, the healthcare stock, was trading at resistance. So my target here was 138. And at this rate, we might get there by the end of this call. So what's kind of interesting is now there's these Apple inverse ETFs that you can buy. So you can actually buy an ETF on a stock. I forget what the symbol is, but they're new products. Apple ETF, Apple short ETF. It's put on by Direxon, and these are company that's a friend of Benzinga's that we've get out of here, that they've spoken at our conferences, and I think vice versa. But anyway, so this is a very new product. So the Apple Bear shares, right? So this is designed to go up if Apple goes down. Now, going on behind the scenes here is all kinds of complex derivative trading and options trading and futures trading and so forth. You don't have to worry about that. This is just like buying a regular ETF, all right? So let's take a look at what AAPD looks like on the chart. It's going to look pretty opposite to what Apple looks like. All right, so AAPL, so here's Apple. And a lot of people don't even know about these because they're so new. And so now this should be trading in the opposite direction. So whereas this is down whatever percent this is, gosh, that's down, over about 15% in 3 days. You could have bought this and notice how this is up, right? So if you think Apple's going down, and these things just came out, the first day of trading was August 9th. But again, it shows you there's a lot of different tools and there's a lot of different ways to make, like, traders should be able to make money in any market. If it's going down, there are ways to make money. Obviously, if it's going up, there are ways to make money. If it's going down, there are ways to make money. It's easier to make money on the downside in a lot of ways because markets go down faster than they go up. That's because markets go down. So now this is going to go the opposite direction of Apple. Yeah, so this is let's see what this does here. Yeah, this is going to go in the opposite direction, but it's going to go by 1.5 times. So Apple bull 1.5 times share. So we can see that, and we can see that's the Apple inverse ETF, and that's Apple itself. But it's not just about the class isn't just about understanding the levels and the trends and so forth. It's also about understanding all of the different instruments that are available, all the different ways you can get exposure. Like a lot of students really, I guess for me, I kind of take it for granted because, I've been doing this for so long, but a lot of students are surprised that you can make money when the market's going down just by buying a simple ETF, just like you can, how we talk about passive investing. That's what people have been talking about for years because passive investing works when the market's going up. Now that things are going down, people are going to start talking about active investing again. But passive investing is just buying an ETF. Well, you can buy an inverse ETF just as easily as you can buy a regular ETF. It's not complicated. So that's one of the things a lot of the students are surprised about when they come into the class. Another thing we talk about is what's the best way to deploy and allocate your capital. If you have 2 stocks and one of them is really volatile and one of them is not volatile, and you have $10,000, do you put 50% of your money into each, or do you put $3,000 into the one that's more volatile? And that's when we figure out where we would get stopped out and how much money we want to risk and so forth and so on. But I want to kind of keep our discussion on the market's I think going to keep going lower. And, of course, if Apple gets down to 138, it's probably going to rebound a little bit. I'd be surprised if it smashed right through. My guess is it rebounds a little bit and then it ends up breaking down over the next few weeks. But one of the important things we got to watch here, Rodrigo, is interest rates, right? And I'm just going to look at this. This is the 10-year rate. And, as long as this thing is above 4%, and, it's going to be kind of tricky for the economy. And you can imagine that this is interest rates are determined by what goes on in the bond market. So I'm going to invert this chart because this is what the stock, or this is what the bond market looks like. So I'm going to invert this. Now, what does this look like? Well, it got to support, it broke the support, and then the support converted into resistance. So that's a sign that we could get another leg down in the bond market, which would mean another move higher in interest rates. So this is really bearish for the market.
Right. And then you look at, well, I mean, I know that you're looking at the 10-year, but yeah, there's just a lot of stuff happening out there. I think Amazon is at a 2-year low. I mean, this is really an interesting time, Mark. It's definitely not a time to wing it, and that's what we can all agree on.
Yeah, you can't. It's like I said at the beginning of class. I mean, you need to take, just like anything that's worth doing, it takes a little bit of time, right? I mean, you can't pick up a guitar and become a master guitar player. You're not going to be Jimi Hendrix, in one day. I mean, you could probably never be Jimi Hendrix, but the point is for some reason people think that, for some reason that like stock trading is easy. I mean, Amazon is in a free fall, and I'll tell you what, a bunch of the students made money on this because someone asked me, I forget who, do you think Amazon's going to beat or miss their earnings? And I said, I think they're going to miss their earnings. And they said, why? And I said, well, Jeff Bezos said that the economy is going to get so bad, you got to batten down the hatches. So when the guy who, owns the company comes out and says things are really bad, there's a good chance that things are really bad. So I know a lot of people are short this or made money off the puts. Looks to me like it's going to trend lower. My target for this is probably this former bottom, which is down around 83. So, down another $6. So yeah, I mean, big tech is just in a free fall, and next up could be the consumer discretionary sector. So right now, what I'm really focused on is on this. The consumer discretionary sector is the fourth biggest sector in the market. It's about 11%, and this is how the market talks to us, Rodrigo. Right? So it's at a support level. What's it going to do? Well, if it starts to break support, that's the market telling us I'm probably going to go down. If it holds, then there's a chance that it bounces. Breaking support means it just starts to trade below this level. And look how clear this is, to within pennies of 135 going back months. I mean, it's really, no academic or fundamental manager could ever explain how a level could be so precise, but traders do. So there's this large group of buyers who are hanging out, willing to buy as much stock as comes in at 135. Well, if that 135 level breaks, meaning that the stock trades below it, it's not just symbolic. What it tells us is that the buyers who created the support with their buy orders have left the market. When buyers leave a market, it doesn't matter what market it is. It's a real estate market, cryptocurrency, bond market, lumber market, you name it. When buyers leave the market, prices go down because sellers are forced to accept lower prices. So I think that this is probably like the most important thing to watch right here is over the next few days, if we start to see this support get taken out or breaking, that's going to tell us the market's going to make another big move lower. So that will be the sign there. You guys hold on one second. Someone's not ringing my doorbell.
All good, no worries there.
Let me go. It might be a FedEx I got to sign for. Hold on one second.
No worries, man. No worries. But yeah, we got a couple stocks here that we'll be looking at afterwards. In the meantime, while Mark goes to get his UPS package, we're pretty much going to wait for him here. But if you have questions on joining the school with Mark Putrino, the contact, the link is in the chat. Let me go ahead and put it on the Zoom side also. And on the YouTube side, you guys do have it there. But yes, pretty much the trading school, as you can see, this is kind of like what it is in class. Obviously, that you would have a live chat room with, hundreds of students there interacting, communicating, sharing trade ideas, education. It's probably the best place for you to start when you're a new trader. It's 100% better than you trying to figure this out on your own. Ultimately, the goal is to help you become a better trader, right? And when you're starting out, you really have no clue what that is, right? So that's part of what we do in the trading school. We show you what matters, what really doesn't matter. And you learn from different strategies, different styles from different traders, and you find your own, right? So that's what it's all about. I think we have Mark here back in the mix.
Yeah, Mark's had a busy day, so that was just a FedEx I needed to sign for. But I'm back. So let's
Speaking of FedEx, why don't we look at that chart? I would have asked him how the package is doing, bro. Like, is he feeling like it's slower? Like how is business doing?
well, let me tell you something, dude. The FedEx guy and the Amazon Prime guy are at my house like every day. All right. Because my wife has a tendency to go nuts on spending. Literally, the Amazon Prime guy a few months ago told me, he's like, you're my number one place. I think I stop here every day. So it's been an issue of contention because I believe we shouldn't buy stuff we don't need, but whatever. This is not a marriage counseling class, but let's go take a look at FedEx. And like FedEx is a company that, the class is mostly based on technical trading, technical analysis. But we do look at things earnings sometimes. Like we would look at the FedEx earnings because FedEx would give us insight into what the broader economy is doing. So, different things are different on different days.
Right.
So we're not just really nailed into just the technicals. If some bellwether comes out like FedEx, you can gain insight into what's going on in the economy.
Yeah. Speaking of that, we have somebody on the YouTube chat says, I'm a FedEx guy, literally on my truck listening. We have definitely been slowing down overall. The GOAT, are you guys using like EVs or like send me an email, man? All right. We'll get in touch. I'll hook you up with the school. But we have somebody from FedEx that's delivering packages right now, listening to the trading school now, Mark.
Well, you know what? We actually have a lot of, we get a lot of actually great insight in the class because, and this is one of the things I'm kind of the most proud of, is that we have such a diverse group of students. Like a lot of our students are farmers. I don't know why, but a lot of our students are farmers, so we can get insight into what's going on in the commodities markets. We have a bunch of students that are truck drivers, so we can get insight from there. When, not that we make people or anything like that, but when a student joins, we like to know like kind of what industry they're in. For example, one of our students who is a contractor first told us that like 2 or 3 weeks ago that the Mississippi River is getting so low that the barges can't get through. Now, I wouldn't have known that. I mean, now people are starting to talk about it, but we knew about that 2 weeks ago. So we do get a lot of insight, and that's pretty good insight from that particular person who works at FedEx, who I hope becomes a student. But if we look here, again, it's the same thing. What was resistance in the past, it became resistance. What was an important level back here became support. So if the market continues to trend lower, I would think we'll find support around 142, because that's where there was support before. But people refer to you might have heard of the term market memory. And that's a term for saying that things can stay intact, or an important support or resistance level can stay intact and retain its importance for a long time. And you can see since September, we had this big sell-off, which I guess was probably on earnings, right? On September 22nd. Well, 161 has been a resistance level since then. And it got there on Tuesday, and that's where it reversed. So again, we see, the principles, and, sometimes they're more clear than in other stocks, as every stock has kind of its own personality. But look at this here, one of the reasons, a fundamental person would say, well, the stock broke down because it missed earnings. A technical person would say, well, it broke down because it broke support. People like to buy at nice round levels, right? So it's not surprising that the $200 level was support for FedEx from March through September. And when that support broke, that tells us that all those people that were willing to pay $200 for it left the market. And I mean, it was because of the earnings. But then the stock dropped, and it's not a coincidence. It found a bottom around 142. It found a bottom here because this was a prior resistance level, and it was a resistance level because it was a support level. So 142 has been an important level for FedEx going all the way back for 3 years ago. So that just shows you these levels can stay intact for a long time. 3 years later, FedEx finds support at the same level that it found support at 3 years ago, or 3 years later, here we are. It's at the same level that it was at back in, well, where are we now? What is today? November 3rd. So, but you can just see on the chart, right? You don't need to be a master chart guru, hedge fund master to, see that this is a clear level there. But yeah, that's one of the things that's pretty cool about the class is that we got people from all different fields. We got, engineers, we got scientists, we got some lawyers. So we get different opinions and we get different insights, and we have a really good student community. I mean, a lot of these students are becoming friends, and, they have study groups together, and they have, a couple of them are planning on going on vacations together. And, the class has been going on for over a year now. So we have people that have been pretty much talking to each other every day for a year. So, yeah, when we were out in Vegas, I think that's one of the things that really struck me about the class, Rodrigo, is that just the diversity, just from, the people from all, people that grew up poor, people that grew up rich, people that are highly educated, people that are not educated but are very intelligent. It's a whole broad group, and I think that's really cool. And I think that adds to it because, like what that person just said there about FedEx, that I mean, that gives us a little bit of insight, right? So, had they been in class, say last August, and they said things were slowing down, well, then we would have said, well, you know what? If things are slowing down, then there's probably a good chance that their earnings aren't going to be that good, and it could break this support. So some of our best ideas have come from our students and not from me, because the ultimate idea of the class is not for me to sit there. It's not like a trading mill where it's me sitting there saying, buy this, sell that. The idea is that people need to learn how to teach themselves, because everyone's got a different personality. So what works for someone may not work for someone else. We have one student who does very well by when something gets to resistance and it doesn't look like it's going to go through and it starts to go lower, he buys puts. But that's his strategy. Something fails at resistance, he buys puts. It's been very effective for him. We have people that just trade ETFs. We have people that just trade biotech. I would say most of it, though, most of our traders, I think, are really interested in, learning about how the markets work. And obviously they want to make money, which is why we're doing this. And so I would say the majority, I mean, I can't really put a number on it, but I would have to say that the majority of the students are either day traders or option traders or swing traders. We do have some people, though, that are interested in long-term buy and hold situations. So that's why sometimes we go through a company's, a company's balance sheet, or we might look at an earnings statement, or like, for instance, I believe someone was asking me about, Bed Bath and Beyond, and it was actually someone who works at Benzinga, and they were saying, because they were all confused about this, all this stuff with all the whole gamma squeeze and this, that, and the other thing. And I said, look, man, Bed Bath and Beyond is not going down because there's some market makers out there manipulating it. All right. Bed Bath is going down because they're losing millions and millions and millions of dollars. All right. That's why it's going down. Last year, in the end of the quarter that just ended, they earned 4 cents a share. This year, they lost 72 cents. All right. That's why this stock is going down. It's because this company is losing. They went from losing $73 million to losing $366 million over the past year. So, that this stock is not going to go up. I mean, people are waiting for this mythical short squeeze that it's going to come, which, I mean, I don't understand, frankly. People seem to think that these option market makers have to go out and buy the stock to cover their options, but they miss the obvious thing of, well, they could just buy another option to hedge themselves. I mean, unless I'm missing something, that's the way that I would look at it. And I'm sure people that are listening to me are familiar with the story that the activist investor bought all these really, really out of the money calls, like with strike prices around like 70 or 80. So the market makers sell the calls. And then the theory was, well, in order to hedge these calls, they're going to have to buy a ton of the stock, and that's going to drive the price up. But me, as a former market maker, is thinking like, well, why wouldn't I just buy a call? Like, if I'm selling the 80 call, I could just buy the 79 call to hedge myself. So, these rumors get around, and, and obviously people lost a lot of money because they are quote unquote learning from someone who is in some chat room somewhere, or some Reddit, guru who doesn't know what they're doing. I mean, I know I'm not going to say, Wall Street's not all Boy Scouts, and there's not people, that play games and are under the radar screen that do illegal things, but that happens in every industry. But for the most part, everyone and every place I've ever worked at has been pretty, I mean, the compliance is they read your emails. A lot of times you can't even bring your phone on a trading desk. I'll just give you guys a quick little overview of the myths, two of the myths of Wall Street. One of them is the whole thing about hedge funds, right? The only difference between a hedge fund and a regular fund is that a hedge fund can charge what we call a performance fee. They get a piece of the action. A mutual fund, they only get paid the management fee. So if there's $100 million mutual fund and it goes up 20% to $120 million, well, then just to make the math easy, you could say they're going to get $1.2 million management fee for managing that. If it's a hedge fund, they're going to get, say, a 1% management fee, but they could also maybe get 10% of the performance. So if they go up $20 million, they're going to get $2 million. So whereas they would make $3.2 million, the mutual fund would only make $1.2 million. I've worked for hedge funds that are as boring as you could, or I should say I've overseen the trading of hedge funds that are as boring as you can imagine. They're long-term, they're buy and holds, and I've also overseen the trading of hedge funds that have actually very sophisticated, complicated strategies. But the difference is the fee structure. And like one firm I worked at, we had three products or three strategies. There was small cap value, small cap growth, and micro cap. So we had a micro cap mutual funds. Then for small cap value, we had a mutual fund for retail investors. We had an institutional product, and then they would take the institutional product would have maybe 100 different names in it. Then they would take the 20 names that they thought they were the best, and they would market that as a hedge fund. So we had there were three different things, but there were two different hedge funds, right? One was small cap value, one was small cap growth, and it was long only. So there's what's called the buy side of the market and the sell side of the market. The buy side is the side where you have to pay a commission to get a trade done. Like a retail trader, like the people listening to me, are on the buy side. So a hedge fund, a mutual fund, a money manager, this place where I spent most of my career was on the buy side. So if I wanted to buy a stock in, say, FedEx, and I got an order to buy 1 million shares, and I call up, say, Goldman Sachs, and the order would end up with whoever makes a market, and they probably have a team that they make markets in transportation stocks, right? That's all they trade all day. It's just what's in this sector. They become specialists in the sector. They, know the earnings, they know the companies. It's like they know what's going on in the sector. They trade that sector. It's probably a group of, 5 or 10 people. So, Wall Street's a place where there's a lot of, show and tell or trying to feel people out. So say I got 1 million shares to buy, and I call up Goldman Sachs and I talk to the market maker. Well, they're going to want to know, what are you doing? I'm going to say, hey, what are you doing? And they're going to be like, what are you doing? And I'm going to say, what are you doing? It's going to go back and forth. Finally, I'm going to say, look, man, I got to do something. And I got something to do on 1 million shares. Why don't you make me a market? And the market maker would look at their stock, and they would look at their chart, and they would look at whatever orders they have. And they would say, all right, here's your market. I'll sell you 1 million shares at 158, and I'll buy 1 million shares from you at 152. So they just made me a market, 152 to 158, 1 million shares up. That's why they're called market makers, because they make people markets. They're not out there looking to rip off the little guy. I think the people that are looking to rip off the little guy are other little guys in chat rooms that are putting out false stuff with pump and dump schemes. No one at Goldman Sachs is gonna risk their $3 million a year job by going out and to try to manipulate some stock to take care of some retail investors or to rip off some retail investors. So part of the class, Rodrigo, is explaining how Wall Street really works, as opposed to the the fiction and the myths that a lot of people believe.
Right. And you've been you've traded with, Steve Cohen, Mario Gabelli. These are multi-billionaires, right? So I guess it's really good for retail traders to get a sense of how, people that have traded with big amounts and understand the market structure, instead of trading from emotions, because I guess that's another big account killer, right? Emotional trading, instead of following reason, a plan. And I know you help people with that specifically.
Yeah, that's our investment psychology class. And the reason why most people lose money is because they make emotional decisions. I mean, think about it. In any aspect of your life, if you make an emotional decision as opposed to a logical decision, you're bound to, or there's a good chance that you make a bad decision. So if you're just buying something because you see it in some chat room, that's like a compulsion. It's like, it's like your instinct. Like, people are buying it. I want to be part of the herd. There's safety in numbers. So they buy it. That's irrational. That's buying something on emotion. The biggest problem that people have is the psychology. And it's that we as human beings have not evolved in a way that's good for trading money, because we experience fear, right? Now, 20, 30,000 years ago, if you were, being run down by a saber-toothed tiger, you would experience fear and it would be a good thing, right? Because it would help you run faster, you'd have more adrenaline, you'd get stronger, so forth and so on. Well, now that we have markets, people are afraid of losing money. People get afraid of losing money, so they make irrational decisions out of fear. So one of the things I get, asked about a lot is people will say, Mark, I don't understand. I had this paper system and it worked really good, and I traded it for a year. When I say paper trading, it means they didn't actually take real positions with real money. It means they just worked out a strategy on paper and they made their trades on paper. So they kept track of, I would have bought here, I would have bought it, sold there. So people say, I on paper, I did really good, but then when I put real money into it, it's not working. Like, what's going on? And the reason that's happening is because emotions are making people not follow their rules. Say your system calls for you to buy 1,000 shares at $10, just to make the math easy. And you say to yourself, all right, well, if it gets to 15, I'm going to sell it. And if it gets to 9, I'm going to sell it for a loss, and I'm going to move on and find something else. So you have a 5-to-1 risk reward ratio here. You can make $5,000 or you can lose $1,000. That's a great risk reward ratio. So now say you're on paper, right? And you're watching the stock and it goes to 11 and it goes to 12 and it goes to 13 and maybe goes back to 12, then it goes to 13 and 14. Then maybe it goes back to 13 and then it goes to 15, and you say, all right, time for me to sell. Wow, this is easy. I made 50% of my money. My system is great. Or say it goes down to $9. You say, all right, well, I'm going to sell it on paper. I'm going to take my $1,000 loss and I'm going to move on and look for something else. That's on paper. Now, let's suppose you put real money in it. $10,000 is a lot of money. So someone puts in 10 grand and their stock starts going higher, and now it's at 11. And they're like, oh, wow, I've made $1,000. And now it goes to 12. It's like, wow, I made $2,000. And all of a sudden fear starts kicking in. Gee, I don't want to lose this. I got $2,000 here. Well, hold on to it a little bit longer. Then it goes to 3,000, and you say, oh, you know what? $3,000 is a lot of money. I don't care. It's not at my target, but I'm going to sell it. I made 30%. So then they sell it, and then you watch it, and it goes to 15. So the fear of losing your profit made you get out of the trade too early. Say it's the opposite side, and you're trading real money, and it goes to 9,000. And you say to yourself, wait a second, I don't want to lose $1,000. And also, too, there's the self-image. I don't want to make a mistake because then people will think I'm stupid, or I'll think I'm stupid, right? So it's a matter of personality and fear. So the two worst things that traders can do, now I'm talking about trading, not long-term fundamental investing, but people that are traders, the two worst things you can do is close out your winners too early and get out of your loser and hold on to your losers for too long. And after a while, you come to identify with yourself and you realize what your problem is. My biggest problem with trading was I never had a problem with getting out of something for a small loss, because I've been doing this long enough that I know there's always going to be other opportunities. My problem, and I still, to this day, I'm aware of it, and I still have it because I'm a human and I experience emotions, is selling stuff too early. So, every human has these same emotions. And since the beginning of trading, people have been experiencing the same thing. So you don't need to be perfect, but just an awareness of this is a lot can bring you a long way. If you can't explain to, well, I don't want to say a 5-year-old, but if you can't explain to, say, a 20-year-old or like, if you can't explain to someone like me, like, why you're making the trade, you probably shouldn't do it. If you say, Mark, I want to buy XYZ, and I say, why? Well, someone in some chat room talked about it, or someone in CNBC mentioned it, or I don't know, I just got a feeling about it. I would say, well, that's not a good reason. If someone says, well, hey, I want to buy XYZ, and I say, why? And they say, well, it's sold off, it's really oversold, and it's at a support level and a big chunk of volume traded. So I think this thing looks like it could make a move higher. I would say that's great. That's a logical reason to make a trade. So the risk management is really, we have an official reading list or book list for the class. And I think there's 8 books on the list, and probably 5 of them deal with market psychology. And one of them, which I recommend to everyone who's listening, even if you don't join the class, is there's a book called Reminiscence of a Stock Operator, which was written in the 1920s, which was about a famous trader back then by a guy by the name of Jesse Livermore. And the stuff that he says in that book is the same things that people say today. Like his rules, for trading are don't trade unless you have a reason. It's okay to be on the sidelines. Cut your losers fast. Let your winners run. The same thing that I'm saying now here 100 years later. And if we still have a stock market and a civilization in 100 years, it'll probably be the same kind of thing, right? Because humans will still be controlling it. I mean, people say like, well, one day these AI funds are going to take over the market. Well, there's a buyer and a seller on every trade. And, so that means there's a winner and a loser on every trade. So it's like one of those super genius Einsteinian, AI funds is going to be wrong. So that's just an impossibility by the way the market works. An interesting thing that I hear a lot too is that a lot of people say they lose money because they overtrade. They feel like they always need to be in the market, and they don't. It's okay to be on the sidelines. If you don't see a compelling idea, you should not be trading. If you don't need to be in the market every day, right? So that's over trading, feeling like you always need to be there, not seeing anything that looks like it's a logical buy, but or a logical trade, but I got to be active. That's a ticket to losing money. And that's like Jesse Livermore said, don't overtrade. One of the most interesting things he says in his book, which I think is really fascinating, is he said, I made my fortune not by being in the market. I made my fortune by being out of the market, right? So that seems a little weird. I made my fortune by being out of the market. But if you think about it, what he's saying is it's okay to stay on the sidelines until you see something that's really compelling, and then you get in. So you're not guessing. You're on the sidelines. You see something that's compelling, bam, you get into it. So really the real secret to the success in trading, regardless of what your style is the risk management and the psychology, because it's fairly easy to make a trading system on paper that works, but what's really hard is sticking to it, because money makes people do irrational things, right? I mean, how many people, everyone knows someone like this, right? Someone who wants to buy a new dishwasher, and they spend 3 weeks looking for the best price so they can save $100. And then they get into some chat room, and someone they don't know, some master Reddit trader guru says, oh, you should go out and buy this stock. And they throw 20 grand at it without even thinking about it. So it's just human emotion. Like, humans want to be a member of a herd. There's safety in numbers. That's why when people are driving down the highway and they come up to a toll booth and there's 15 lanes and all the cars, there's 50 cars going into one lane, and then that's the herd. People come up and the instinct is, oh, I got to get online. Those are the people that lose money in the market. The people that make money in the market are the people that drive up and look and say, hey, wait a second, that lane over there, it's got a green light, but no one's going through it. So you pull out a line and you go and you cut ahead of those 50 cars and you go through that green light and you save yourself, 20 minutes, and you look in the mirror, then you see other people following you. But the herd instinct is to, there's safety in numbers. So people have this natural thing to be in the herd, right? So that applies to driving through a toll booth. It applies to sports, right? Like, you like a particular football team and you're at some restaurant or a bar hanging out, watching a game, and someone else comes in and they're wearing a shirt of the team that you like. And it's like, all of a sudden you feel like a bond with this person. It's like, you don't even know who they are. It could be an axe murderer, but it's like, oh, hey, our team's going to win, blah, 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 blah. So we have to be aware that sometimes our decisions are not entirely our own. They're determined by external stimuli. And an external stimuli or stimulus, I don't even know what the right word is to want to be a member of the herd. So, hey, everyone in this chat room is buying XYZ. I want to buy it too, because I don't want to miss out. If I don't want all of them to make money and for me to be the only one who does it. So the herd mentality, which is a human emotion, makes people do illogical things. So that's why you've heard the term, everyone credits it to Warren Buffett, but people have been saying this since the beginning of markets, like, sell or buy when there's blood in the streets and sell when everyone's euphoric. If there's blood in the streets and everyone's selling, well, what does that mean? People are panicking. Why is that a good time to buy? Well, because if I shouldn't say everyone, but if the vast majority of investors are bearish, well, what are they going to do? They're going to sell their stocks. And eventually the market is going to run out of sellers. And then the only way it can go is up. If everyone's euphoric, like at the top of the Bitcoin phase or at the top of the Reddit crowd phase, the market runs out of buyers. And then there's the only way it can go is down. There's a famous Wall Street story, and I have my personal version of it. So Joe Kennedy, who is the patriarch of the Kennedy family, the JFK's father, he was, if you didn't know this, he actually was a Wall Street a guy. He made a lot of money on Wall Street back in the 20s. So anyway, one day he's on his way to work, and this is the legend, and it's probably, it could be true. He gets his shoe shine, and the shoe shine boy starts giving him stock tips, right? Like, oh, I've been buying this stock and buying that stock. And so he took that as, it's time for me to sell. So he went to his office and he sold, and then he shorted, and he made, how many tens of millions of dollars. So it's nothing against shoe shine boys. It's just the concept that when people that don't buy stocks typically are buying stocks, there's no one left behind them to push the price any higher. So I had a similar experience, which we kind of laugh about in the class a lot because they were here when it happened. But right towards the end of the year, I could even get you the exact date if I was to look at my bills. But anyway, right towards the end of the year, I had a plumber come over here because I had a leaky pipe in my laundry room. So he sees my screens and my computers and everything, and he's like, "Oh, are you a day trader?" And he was a younger guy, he's about 30. And I was like, "No," I told him I did, and so forth. And he said he had two friends. One was a plumber and one was an HVAC guy. And he said they each left their trade to become day traders, right? So these are people that don't normally buy stocks are buying stocks. And that was right up here. So there's no one left behind them to push the market any higher. The market effectively runs out of stocks. I think then a few weeks later, I was down at the local deli, and I think that was probably right here. right after we made this peak, and there was these two guys in front of me in line that were, you know, some kind of manual labor. I'm not really sure, and I'm not making fun of manual labor. I mean, I'm from a blue class, like a lower middle class family. I guess you could even say we were poor, but you know, they're on their, you know, I see they're on their cell phones, and I noticed that they're day trading. And one of them says to the other one, it's like, oh yeah, I think the market's going higher. I'm buying this, and I'm buying that. And that was at like right at one of these peaks. So I'm not busting on these guys or anything, but I'm just saying that's what we call market sentiment. And when the market sentiment gets really bad, it tends to be a good time to buy because the market's running out of sellers. And the sentiment is really euphoric, like it was in the Reddit craze or in the crypto craze or in the cannabis stock bubble. The market runs out of buyers, and then the only place it can go is down. So these are things that we teach in the class, Rodrigo. That would come into the sentiment is part of the risk management. And it's like, I'm sorry, the investment psychology class.
Right. No, definitely, man. So I think we've been here for quite some time, Mark. Maybe do you want to take a couple tickers from the chat? Or...
Yeah, sure. I can't see the chat, so just fire away. Let me know what people are looking at.
All right, folks, put a couple of tickers in the chat. I know somebody asked for McDonald's before, so we'll look at that. In the meantime, while you guys put some tickers in there.
Let's see. Good old Mickey D's. Well, once again, we can see a couple of our market principles here. Not as clear as some of our other stocks, but we can see we ran into resistance at a prior resistance level. Okay. Now we broke resistance and came back today and we retested it. And this looks like to me that there's a chance that this could move higher. And the reason why is because when something breaks through a resistance level, like this broke through 267 or 268, when the resistance converts into support, like we talked about before, because of seller's remorse, when enough of those sellers who sold regret selling and decide they want to buy the stock back, they place their buy orders. If that doesn't happen, the breakout can reverse like really quickly and just come right back in. But if you'll notice that today we got down to around the same level that was resistance, and it looks like it's been becoming support. So this could be setting the stage for a new move higher. And moves higher take some time to build. Like we can see right back here. Like we could see here, you know, resistance here became support here. And the fact that it became support told us that we were setting the stage for another move higher. So things move up slower than they go down. The opposite way to look at this too would be, well, if it reverses and it breaks this resistance, you would get on the short side. But the fact that this resistance level looks like it's converted into support is, you know, it looks bullish. It looks like we're building a base for another move higher. And it kind of makes sense because McDonald's is the type of company where I forget what the economic term is for it, and which is kind of silly because I was an economics major. At least undergrad. Graduate school I was a finance major. But you know, if it's like, all right, well, instead of going out to the nice restaurant, I'm making less money, so I'm just going to go over to Mickey D's, you know, instead of going to like the Capitol Grill and, you know, and buying $100 steak, I'm just going to go over to McDonald's and buy a $2 burger or whatever. So this is the type of stock that could go up when things are going down. But yeah, you know, we see our same principles. We have support level here, you know, support turning in a resistance turning into support, market memory of support down here. All right, what do you got next?
Then we have Dan Z for Airbnb.
What's the symbol for that one again? I forget.
ABNB.
No, what is it? There's an R in there, isn't there?
I don't.
Oh, here
think-
it is. ABNB. Yeah, you're right. I'm sorry.
Yeah.
My mind gets kind of scrambled sometimes. You know, when you like look at charts all day. So we could see all right, so this has got something interesting going on that kind of catches me right off the bat here. First, I'm going to review our principles, but what we can see is support back here became resistance here. So support back in December of 20 at the 125 level became resistance in June and in August and in September. And we can see support here kind of became resistance. But what catches me, what sticks out at me is that this thing is getting close to a former support level. So let's see if it's oversold. If our indicators indicate that it's oversold, we'll put in our Bollinger Bands again. And we look at a couple different momentum indicators. This is Bollinger Bands is just, you know, it's simple, it's effective, but different students use different things depending on what fits them. All right, so we can see it's oversold, right? It's below that band. And again, according to statistics, 95% of all trading should happen in between these two blue lines. So when we get outside of the line, like here, it tends to reverse, or here it tends to reverse. Here we see reversal. So what I see here is a stock that that's oversold, and it's getting to a close to a former support level. So I think if this thing gets down another $5 to 85, there's a good chance that it bounces. And I'm not saying it's going to, you know, rally back up to 180, but there might be, you know, a trade here where it bounces from around 88 up to this former support level where there will probably be resistance. So like right around there. But here's the thing, I would wait for the reversal. If you're just trying to catch the bottom and you're just guessing, like say it does get down to 88. Well, to catch a reversal, you know, you're not going to get the bottom, the lowest possible price you can. You're going to give up a couple points, but the odds are going to be greater in your favor that the trend that you're expecting has continued or is going to continue. So one possible way to do that is if this gets down to 88, this RSI indicator here, which is a very common momentum indicator, which is available in pretty much any trading software, this will be oversold. So a possible way to say, all right, it's reversing is when this blue line gets back above this dashed line. Well, let me make that lower line look a little bit more, make it easier to see here. So if a stock is going down and it's oversold, one of the first things that's going to happen for it to go back up is it for not to be oversold. That means it's not going any lower. So if this goes below and then it gets back up, there's a good chance that the uptrend has started. So you could say I'll buy it at 88 because that was former support, and maybe it bounces, but a lot of times support levels break and resistance levels break, and the market looks pretty weak. So we don't want to catch the falling knife. We want to wait for the reversal to get underway. It's almost like, you know, picture you get to a train station and there's, you know, you need to go west and there's a train that needs to go, it's on your track and you don't know if it's going to go east or west. And if you just jump on it, you're just guessing which way it's going to go. If you wait for it to start moving west, then you say, hey, this train is going my way, I'm going to go jump on. Of course, you don't get on right when it started. You're going to miss, if you could put it in stock market terms, you're going to miss a few feet or a few yards of movement. But if you just got on, the thing might start going east, and then you got to jump off, and that would be the equivalent of losing money. So you give up a few points, but the risk reward factor tilts way forward in your favor. So that's why I advise students to, if you're trying to buy a trend change, wait for there to be some kind of evidence that the trend you're expecting is actually occurring or is starting to occur, as opposed to just buying it. Because if you're just buying something just because it got to support, well, I mean, I guess you kind of have a reason for buying it. But if you wait for the reversal, the odds are going to be much better in your favor.
Right, perfect there, Mark. So, all right. So, do you have any closing remarks here before we do wrap it up here for the folks? I'm just gonna stick around answering some questions, if anything. But any closing remarks on your end, Mark?
Yeah, well, I think that I do think that the market's going to go lower. I do want you to realize that there are ways you can make money if the market goes lower. But ultimately, that's my opinion. And we're going to watch the market, and we can tell it's going to be going lower if certain certain support levels break. Like we looked at this consumer discretionary sector, and this is pretty much what I'm focused on now. If this 135 level breaks, that's the market telling us we're going to make a move lower. I think it's going to happen, but the takeaway is that successful trading doesn't need to be complicated. It's probably simpler or more simple than you think it has to be. You got to develop a style that fits your personality, and you have to let the market tell you what to do. You don't guess or take ideas from other people. So that's it. So hopefully I'll see some of the people that are here today in class tomorrow morning. Our Friday morning class is we pretty much just kind of review the week and talk about various things. So, all right, everybody. Well, thanks a lot. I enjoyed talking to you, and I hope to see you in the class. And Rodrigo, thanks a lot, dude. I'll talk to you soon.
Absolutely. Mark Putrino, there you go. Chief educator at the trading school. If you guys want to join, the link is there. Let's go have a big shout out there for Mr. Mark Putrino.
Okay, everyone. Thank you, and have a nice afternoon.
All right, Mark. And for all the folks that are here, I put the link in the chat, folks, so that if you do want to trade with Mark, a former hedge fund manager that traded with Steve Cohen, Mario Gabelli. For all you guys that are new here, if you don't know, these are multi-billionaires, okay? They're known worldwide for their performance. Mark Putrino traded for both of them. So I guess that speaks by itself. If you are new as well, just know that there is a 30-day money-back guarantee. So worst case scenario, you get your money back. Not a bad worst case scenario in this market, especially if you are going to learn something, right? If you think you're not going to learn from somebody like Mark, I think you're wrong. You should give this a shot. That's why you have the 30-day money-back guarantee, to really try it out for 30 days. And it also does come with Benzinga Pro as well. So Benzinga Pro is our research terminal platform. Imagine like Bloomberg, but more affordable and faster, and retail, basically tailored for the retail trader. So all you have to do is click on the link on the chat. If you have questions, there are questions. There's the link there where you can email or call. Other than that, folks, it was great being here with you guys. I look forward to seeing you guys next time and in the school, because we do have a lot that we will be covering there. So big shout out to all you guys that were here. We'll see you guys in the school. Have a great day and happy trading, folks. Let's go.